Welcome back. My name is Arya and I don't waste your time, so let's get straight into it. Ladies and gentlemen, in today's video, I was gonna do like a everybody relax, let's cover the whole DeepSeek situation, and we'll do that in this video as well. But I kind of want it to be a little bit different because there's a bunch of YouTubers already making that video. So instead, what we're going to do is top stocks to buy amid the sell-off. And actually, what I'm probably going to personally be buying amid the sell-off. Of course, I always track my portfolio publicly, including the performance and all that great stuff, pinned always at the top of my Twitter. And so this is the current state of my portfolio. I gave a very, very detailed sort of a summary analysis where my head's at a couple days ago. So if you want to read that, you go ahead over on the Twitter and read that. But basically, to summarize, I have a little bit of cash to play around with. And a couple days ago, I was like, oh, the market's running up and it's looking like it's going to run up a little bit more. Everything's kind of getting a little bit expensive. My best idea is Uber, even though it was like 15% cheaper, right? So I was kind of looking at this, and thankfully, this dip came at a beautiful, beautiful time. So me personally, I'm looking to kind of increase my position in ASML and Uber. We'll dive into the valuation and stuff a little bit later on. But first and foremost, let's cover why the stock or why the market in general is just down as a whole. And so it is currently 4:14 p.m. So actually the market just recently closed, but you could kind of see that, like, between all the big tech names, the only one that was surprisingly in the green, which I saw a lot of memes floating around over on Twitter, but it's Apple. Apple, the one that doesn't invest in AI, hasn't innovated, doesn't grow revenues. When DeepSeek and this type of stuff comes out, it's kind of like a safe haven among the tech names, right? So I thought that was very interesting. Of course, the big headliner is Nvidia, that traded down 17% today. And of course, 17% for your average stock it's a lot, but still, like, it happens from time to time with bad earnings or bad catalysts, whatever the case is. But for something like Nvidia, the world's, at least as of yesterday, was the world's biggest market cap, or one of the biggest market caps in the world. That level of sell-off with that type of a business translates to losing one Visa worth. And so I tweeted that out earlier. And by the way, Visa is like a pretty sizable market cap. It's 650 billion worth of market cap, or MasterCard 500 billion in market cap, right? And so yeah, the difference of that, it was 3.5 trillion market cap yesterday, Nvidia, and it's 2.9 today. So that's $600 billion of market cap that it lost. Just ridiculous amounts of money. And so to those of you who haven't been around in the market that long, of course, this type of stuff happens. And this type of stuff happens. It happened August 5th, which was coincidentally my birthday, actually. But on August 5th, something to do with the Japanese yen and I don't even remember what it was, to be honest, but something to do with interest rates. And the Japanese market had the second worst day it's had since Black Monday, and it was coincidentally on a Monday. And so just all this stuff, right? And we had a big dip on that day. All your usual suspects were trading down 10-20%, whatever the case was. And this is the type of headlines that you get in times like this. You get all these, like, worried looking people. Like, look at this guy in the picture of this. Yeah, he's so worried. He's like looking at this monitor, all that type of stuff. And this is supposed to drive engagement. This is supposed to kind of scare you out of these stocks. And this is what half the battle is as an investor. You could be a great investor fundamentally. You could go research the stocks. You could do your valuation work properly. You could try to, dollar cost average into it and do all the necessary steps properly. But then the other half of the battle is actually holding on to these businesses when they trade down, and they happen a lot. And actually, it kind of ties into, I believe, psychology and that type of stuff, but there's a concept known as loss aversion, where it states that negative things that happen to people, just in general, it doesn't have to be like investment related, but it also ties into investments. Negative things that happen to you, you feel them more intensely than joyful things or good things that happen to you. So, like, this is the example they give here, which is, money related. Losing $10 feels a lot worse than gaining $10. You gain $10 and it's like, okay, cool, yeah, whatever. And it's same could be said about investments. For the past year, 2 years, all our stocks have been going up and up. And, like, yeah, it feels good in the moment. Maybe the day that one of them trades up 10%, you're like, wow, that's amazing, whatever. And then you kind of move on. But then on the downside, it's a lot more hurtful to lose money. And so you have to kind of understand that this is a cognitive bias that just people have in general, and you need to be able to weather the storm. How do you weather the storm? You weather the storm by owning very high quality businesses that you're highly confident in, even if they were to trade down. So for example, ASML is one of these stocks that has traded down today. And over the past year, they're down from a peak of roughly $1,100 per share, now below $700. Recently, they were even lower than that. And so that represents roughly a 40% drawdown. Oh, sorry, I'm blocking it here. I always do this. But yeah, that roughly represents a 40% drawdown on the stock. And I am genuinely, when I say this, like I'm emotionally just not impacted at all. And the reason for that is that this is a business that I am highly confident that in the long term will do well. I've done a great amount of research. I understand the fundamentals in and out. And even though, like, one of my main rules is that I'll sell a stock if there's fundamental deterioration with it. So for example, Starbucks, I sold earlier in the year because I was completely blindsided by that quarter that they had where, you know, it's like negative 10% revenue growth, all this crazy stuff. I didn't foresee that coming in. I'm like, you know what? I'm not going to stick around for the turnaround. I'd rather have my money invested somewhere where it's intrinsically growing, right? And ultimately, we kind of forget that these are companies at the end of the day. And with ASML, it's kind of tinkering on that side because technically, it's not actually growing at the moment. It is facing negative growth. But this is a cyclical name. And that, again, ties back into my upfront sort of research when I did it initially of understanding this is a cyclical name. It could have down years. And it has had down years in the past, right? So we got to be okay with that. And so if your portfolio was red today and you lost money and maybe even you made a couple buy and sell decisions, maybe take a step back, close the brokerage app, kind of think about like, do you believe in these businesses in the long term? Go and think back to the original thesis that you had of initially buying into these companies. And listen, at the end of the day, if you're following a channel like this, you probably buy good businesses, well-known businesses, blue chip businesses that are going to do well in the future. And so we just kind of have to tune out the noise. And that's ultimately what it is, right? I mean, like I said, it wasn't too long ago when we had the little dip with August 5th and you had, I don't know, the S&P itself traded at down like 6% in a handful of days. But with like, for example, Amazon and stuff like that, and we could actually pull that up if you guys want. But like with something like Amazon, actually it's kind of hard to see here. Maybe I'll just go back to FinChat. By the way, ladies and gentlemen, FinChat, the company I work for, and we make, in my opinion, the best stock research software, completely free to try out, by the way, if you want to just top link in the description. But yeah, if we click on the 6-month time frame, and I think this is roughly 6 months ago, the August 5th occurrence. And actually they had earnings right before, so it's kind of skewed. But yeah, like it traded, you know, from like 185 down to $160 a share. Traded down over 10% in a handful of days. Like the markets are volatile. We're investing in stocks at the end of the day, and these type of things happen. And so anyways, enough talking about macro and all that type of stuff. Let's hit some stocks that I'm eyeing at the moment that I think are attractively valued. Now, this is a spreadsheet I put together myself, and over time, I've kind of curated it, and I've started to realize that like it's not one size fits all. All these businesses are different in their own right, and they're going through different investment cycles and that type of stuff. So like, you know, essentially what I'm trying to say is just take this with a grain of salt. This is based off of free cash flows, right? So we're looking at the current price to free cash flow of the company, and we're dividing that by the growth rate, and then it kind of lists them out here. So green would be undervalued, red would be price to perfection, right? So you might notice, like for example, Microsoft is price to perfection according to my spreadsheet that I built here. But like, is it really? Because currently Microsoft is doing a lot of capital expenditures, building out their data centers, and they just said they're going to do $80 billion of capex next year, right? So that's going to impact the free cash flow figure here, right? And so naturally it ranks it lower. And then you compare that to like something, for example, like Salesforce. Actually, Salesforce technically has overstated cash flows, but like not really, because like at the end of the day it is free cash flow, because they actually receive cash at the start of the year for services to be provided later throughout there, because it's a software company, right? And many of these companies are on annual plans, so they pay upfront for the entire year. You know what I mean? And so they end up getting that cash flow earlier than they actually technically earned it as per GAAP accounting. It's called revenue recognition laws, right? So some of these are different, and of course, like depending on the growth rate of this, it can definitely fluctuate it, right? So for example, if we take Uber down to a 20% growth rate, all of a sudden it just jumped to a 1.5 times free cash flow to growth multiple, right? So nonetheless, you'll notice like by far the cheapest one on a cash flow basis, and actually it'll probably be cheaper if we assume a 30% growth rate, it's Uber without a doubt. And I've been pounding the table on this one. I've been saying it is a screaming buy. It is extremely attractively valued. I stand by that. I think in the coming weeks, part of my 6.6% cash position, I'm going to definitely put it into Uber. Adyen is a bit of a different one. This isn't actually their cash flow. I think this is operating income, and then I've put it to dollars from euros. So I adjusted the currency amount. But anyways, that's a bit of a different one. And this one I'm not as confident into. And to be quite honest, I don't actually understand the business that well. Like I understand it in theory, but I don't understand it too well. You might notice NVIDIA is here, and this is actual free cash flow. That's the actual stock-based compensation amount. And I've put a 35% future free cash flow growth rate for the next 3 years, which is like pretty achievable because they're probably going to grow revenues at like 50%. Even if we assume no margin expansion, you're pricing in like a very conservative growth rate for the next 3 years. And so currently, NVIDIA, after the dip at $120 a share, and even before today at $140 a share, it looked pretty attractively valued. The only issue with NVIDIA is the predictability of these revenues is highly questionable, especially with the DeepSeek stuff coming out. And me personally, I'm not quite sold on the DeepSeek stuff being that impactful. And the reason I say that is because I just don't think it's real. Like I find it hard to believe that with $6 million, these people were able to essentially replicate all of AI and all of ChatGPT and all that type of stuff. Maybe it is true, maybe it's not. But to me, I'm a little bit speculative of this obscure Chinese company just figuring it out that quickly, right? So I don't know. I'm here to kind of, I've always been like a fundamentals first investor. So it's really up to you to kind of decide like what you think of the risk versus reward. But I'm just saying on a just pure fundamentals basis, assuming a 35% growth rate over the next handful of years, NVIDIA is a very comfortable buy at the moment. It trades quite cheaply. Moving on, ASML. And again, I should put a caveat with this. This is not the actual free cash flow number. What I did instead is I think I put the operating income, and actually maybe we could go back here and take a look, right? So if we go over here and we pull up operating income, yeah, I believe I think I got operating income or operating cash flow. I don't know. Oh no, because this is in euros, right? So it's 8 billion euros. And then if you do USD, yeah. So for full year 2024, it'll be an estimated 9 billion. We'll find out in like 2 days, literally. So that's where I got that number from. Or no, I put the euro in there, and then I just put it against the US dollar, right? And so with that, I think ASML is quite attractively valued as well. And actually, this is a company that always trades at a premium. So on the spreadsheet, it might not show up that well. But I mean, if we simply just toggle on the forward PE of this business, and you with this one, you don't really want to focus in on, like the 2015 to 2019 period, because it just wasn't the same business. Like EUV really got established post, I think 2017, 2018. And like, that's when this business got a much higher valuation bid. And so if you look at it over the past 5-6 years even, and maybe we'll take this back one. Yeah, I think like around 2019, right? So let's just look at the past 5 years, right? And if you look at the past 5 years and we just simply toggle on the median, you could see that it's traded at an average forward PE of 34. Or sorry, a median forward PE. I think the average would even be higher. Yeah, so your average is 35. So it's on average traded at 35 times forward earnings. And right now you could go out and buy as many shares as you want for 28. I don't know where 86 came from, but you could buy as many shares as you want for 28 times earnings. And honestly, in terms of the long-term future prospects of the business, basically nothing has changed. And I think this company could like very comfortably in the long term average around a 20% growth rate to either free cash flow or earnings. Like if you look at their long-term 10-year EPS growth rate, it was 17%. I think this coming decade, they could sustainably do around 15%. And so that puts you like, just barely on the undervalued side of things in terms of free cash flow to growth rate. But then you got to think of it like this is ASML. It's one of the most special businesses in the world. They're an outright monopoly in terms of the lithography machines that they make. And by the way, if you're not too familiar with the company, I'll put it up on screen now if you want to watch the full stock analysis of it. It'll also be linked at the end of the video if you want to watch that afterwards. But it's one of the most powerful businesses in the world, and we need it for the AI revolution, right? Now, enough about talking about free cash flows. I made this exact spreadsheet, but just with operating income as well. And again, you can kind of look through it yourself right now. And I'm going to remind you, this is not like perfect, science. It's a lot more art to this, and it's not perfect, especially because these growth rates, like as soon as you adjust these out, right, it could drastically affect the results that you get over here, right? So like, for example, something like Amazon scores the best in terms of operating income for us. But then if you go back here, Amazon's a little bit further down, right? It's fairly valued, not extremely undervalued. And anyways, in terms of buys today in my circle of competence, those are the ones I'm kind of looking at. I'm looking at ASML, I'm looking at Uber. And honestly, some of these other like Amazons and Googles, like they're either fair value to like slightly undervalued. And then of course you have like the long-term, they surprise us, right? They keep beating earnings. And so it's technically a little bit cheaper on a forward basis at all times. And so with that being said, thank you very much for watching. One last thing before you guys move on, I started my own Discord. The catch is it's $1 to join, only for the first 200 people. And I think there's only like 30, 40 spots left. So if you're watching this, in the first like day or two that it comes out, feel free to go sign up for it. It's one of the links in the description. While you're down there, check out FinChat. And yeah, thank you for watching. Have a great day.